Good morning, good afternoon, good evening, and welcome to the Bull versus Bear webinar on Thursday, the 5th of January. Steve Miley on the call here for TradeDay.com. Welcome, everyone. We're going to go for our usual regular run through in here today. Calendar, what we've had, what we've got coming up. We'll take a look at the articles from the major news wires regarding the macro fundamental economic data and central bank events and geopolitical events that are driving markets right here, right now. And we'll take a look at the charts, see where the trigger points are, what's interesting on the charts going into today's trading session. So first of all, calendar. Let's do a little look back before we go a look forward. So we'll go to yesterday's calendar. We'd already covered with the positive European PMI data that we'd already had yesterday, and the French CPI data. Obviously, then all focus switched to the US. With the ISM manufacturing data in here, slight miss, slight disappointment, but very slightly under. Notably under on the prices number, but notable miss in here. So the prices number is good, right? Because that's lower prices, i.e. then lower inflationary pressures. But the PMI data, but I mean a very, very marginal miss in here. And obviously the market was more focused on the Fed minutes. Fed minutes yesterday, probably, if anything, slightly more hawkish than expectations. Yeah, and the market certainly reacted like that. Stocks were down initially. However, the market dealt with it very well, I feel. They were certainly more hawkish in their tone. We'll come to that shortly. And let's go and take a look at the Fed tool. And that's kind of reflected in here, where this, as you think this is for February. So just about, just over a month's time, just under a month's time, sorry. The February release or decision. This was up in the 70 kind of area yesterday, down to 64. This is the 25 basis point rate hike. So a slightly increasing chance of a bigger rate hike. And if we go through March, this is still saying, but this was a slightly higher, I think, in here, more chance now of then a bigger rate hike coming through March and then May. And then we go to the peak is the most interesting. The Fed really made a point of telling us two things. The market's probably not pricing in quite as high, and they are pricing in the 500, 525, and the market was pricing in the peak at 475, 500, and they've kind of indicated to us 500 to 525, the Fed. And the market started to price that. You can see in here the peaking rates now. The actually the highest peaking rates in here into June is the 500 to 525. And if we go then through July, it drops back down though to 475 to 500. And then as we go through September, stays at 475, 500. And then by the end of the year, December, it's 450 to 475, which is only 25 basis points up from where we are. So the market's starting to price in at least 50, more likely going up to 75, but still pricing in the cuts. And the Fed, the two things, one is saying the Fed is saying, well, we're probably going a bit higher than you expect, but also we're very unlikely they're going to stay there. We're going to stay there once we get up to that level for the year. Okay, and the market's certainly still pricing in cuts going into the end of the year. So the market did react to one of the sort of messages the Fed have been trying to send, that rates are going higher than the market's pricing in, but the market hasn't really reacted to the fact that the market is expecting cuts, and it's because of what the market believes is there's going to be a significant recession, and the Fed will react to that recession and be cutting by the end of the year. So the market doesn't believe the Fed that they're going to be able to stand in the way of, as the market goes into recession through the year, into the summer, that they're not going to then be reacting by the end of the year by cutting rates. Okay, so a definite reaction there. So that's been the tail of the tape. Now, from my perspective, given that the Fed were relatively hawkish, given that the interest rate market here did react, not fully react, because it didn't react to the Fed telling us, higher for longer, but the market did react to higher. It didn't react to longer, but it did react to higher. I felt the equity markets dealt with it very well, because the initial knee jerk was down, it rebounded, and it was a relatively solid day. I think if we had that statement, those Fed minutes 2 to 3 months ago, the end of last year, we would have been making new lows on the equity markets. They would have been plunging, and we would be making new lows. So the market, I felt, dealt with that. The equity markets, the indices, dealt with that very well. So I just wanted to remind you this one. I'm going to put it in again. I think this is available to all. I mean, I do have a subscription here to Bloomberg, but I think it's available to all. I think it's. I did look through it when I hadn't looked through it previously. I did look through it. I think this is a good little summary of what Wall Street is basically expecting, and I think it's worth going through. If you have got access to Bloomberg, you've got access to this. I would certainly take a look at that. Right. 5 things you need to know to start your day. Let's run through. So Fed resolve, Fed underlines determination to stamp out inflation. Yeah, so that's what I kind of said. Officials noted a misperception of the Fed's reaction function would complicate the bank's goal. So this is what it said. The market's not pricing it in, right? So give them minutes gave few about where the next rate in February will be 25 or 50. Okay, so disappearing jobs. While official data seems even to get a strong jobs target, job openings beating expectation. More readings due from ADP today. So actually, let's go back to the calendar. I've skipped off the calendar, right? Let's go back to today's calendar. So the big focus. So we have had some German trade data, not that interesting. We've had some UK composite and service sector PMI data, pretty much in line. It's very, very minimal list from the UK in here this morning. Do have a little article on that coming up though. The focus today in about 40 minutes time, we've got the ADP non-farm employment change. Remember, that's the kind of the guesstimate. That's the non-official estimate of what the non-farm payroll number should be. Okay, so we've got that coming up. Market rarely moves significantly on that these days, but you never know. With the market, particularly with the equity stock indices at the moment, very much paralysed in a sideways consolidation range. Market's really not moving much in here since before Christmas. Given that they might need a jolt. If we didn't get a jolt from the ISM PMI yesterday, and we didn't get a jolt from the Fed, I don't think that's going to be enough to give us a jolt, particularly ahead of tomorrow's official employment report. And then we do get a few other things in here. We get Bostic. We get then the not as much watched the S&P Global Composite and Service Sector PMI data. That comes at 9:45. So we've got in about 38 minutes now. We get the ADP number at 09:45. We get the S&P Global. Bostic speaks ahead of their 09:20. Okay, these are all Eastern time, and then Bullard at 13:20 Eastern time as well in here. In between that, 11 o'clock, we get gasoline oil inventory data. Okay. So moving back to 5 things starting today. So yeah, jobs data in here, and ADP being watched today ahead of tomorrow's. Equity hopes hoping for a reprieve are likely to be disappointed according to. So yeah, it's just more Wall Street stuff. Markets kind of quiet in here, relatively quiet in here overnight. Okay, what else do I have in here for you? US futures tick slightly higher before data. Oil rebounding. Oil's been under massive downside pressures. We really kind of got a dislocation. Oil and stocks were very much aligned, risk on, risk off, rallying when we were kind of in risk on mode. And, you would say the market at the moment is staying slightly in risk on mode. Equity is not really giving us a clue either way. You look at European stocks, I've been focusing on this with you guys. European stocks have had a really strong start to the year. Yeah, they were up Monday, Tuesday, Wednesday. Okay, so really strong start to the year from European stocks, with US equity markets pretty much sideways since before Christmas. So we're kind of I would say, from the equity markets we're in risk on. The oil market's telling you we're in risk off, right? With its plunge down to recent lows. And I've got a stat in here, the biggest one-day drop for I don't know. I'll come to the stat in a minute. So S&P in here closes higher, slightly higher, but I mean it was higher within a range, right? It didn't really go anywhere. After Fed confirms inflation focus. So even though the Fed relatively hawkish, futures muted as Fed minutes confirm more tightening ahead. So a relatively muted reaction, which I think is a positive reaction given the Fed were relatively hawkish. Okay, no Fed cut. Markets think it's more than a matter of minutes. Data points suggest the central bank could be too hawkish. Okay, so that's what we're saying, right? The market is pointing to the Fed being too hawkish. Okay, and markets made a mistake clinging to them 12 months ago. China markets start 2023 with a bang. So developers, tech shares lead broad China rally in 2 days. Whoops. Oh, it says something pop up in here. Sorry, guys. Let's get rid of that. So China markets start with a bang. So Chinese stocks are higher on various policy shifts that we've seen in here. But then oil's telling us a different story. Oil has rebounded, but look, after the biggest drop in decades. I'm not quite sure what that says. 9% in the first 2 trading days of the year. What's the date? What's this biggest drop in decade? I guess maybe it's the biggest 2-day drop in decades. I'm not quite sure on what the actual stat is. Don't really tell us, but just skip reading it here. No, I don't think it actually shows us. But, oil's telling us a different story, okay? But that doesn't mean that, one market could be wrong. Here's a reflection of the European markets doing well. FTSE higher. Next is a retail chain. I'm not sure if you're aware of that for our US and Asian, but it's a big retail chain in the UK. Next, giving some positive soundings despite recessionary fears. Next takes comfort from UK's low unemployment. So unemployment rate's still relatively low. And if we look at the European bourses this morning, they're kind of fairly flat in here today, but the FTSE is up. Excuse me if you can hear background noise in here, guys. My apologies. And then we've got the US exchanges overnight having mildly higher in here yesterday, 0.75% up for the S&P. We're kind of flat, just very slightly higher in here going into this morning. Okay, let's take a look at a few of the charts. So, I've been stressing this. There's the range from the 22nd of December. The market is still inside that range. 1, 2, 3, 4, 5, 6, 7. This is the 8th trading day. We've been inside that daily range. So a very, 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 very tight sideways consolidation. Noticing here, the market has held above the 61.8% retracement of the whole rally. Okay, and it continues to hold above there, but capped below the 38.2% retracement of the sell-off that we saw from the middle of December. So we're between these, the 61.8, which comes in around 37.77, and the 38.2, which comes in around 39.38. Okay, so trapped in there. I've still got no real strong view in here, and I've been saying this, guys. I wouldn't be trading it. I think it's too difficult. And I said yesterday, keep your powder dry. We obviously got the knee-jerk lower on the Fed, and then the market in here. So there's the initial move lower on the Fed, and then the market bounced and then choppy, and then ended up with grinding high. I've still got, hold a gun to my head, 55.45 bullish. Okay. But I mean, you've got this succession of higher highs and higher lows in here since the sell-off that we saw here back at the beginning of the year. So, it does look mildly positive, but I'd say it's mildly positive. And the Nasdaq's kind of similar story in here. Not quite the same consolidation that we've seen. We did go lower into the end of the year and rebounded. And then we had the significant sell-off on the first trading day of the year there. But the market's trying to claw that back and positive going into today. But again, no strong view, slightly bullish. It's held this support area here between 10.860 and 10.845. It's held there 1, 2, 3 times now. So slightly bullish in here, but I mean, it's marginally bullish, very, very marginally bullish. Okay. And I know in my reports I've got negative in here, I mean, I think that just the overnight activity, the slight positivity overnight gives me a slightly, but I mean, it's marginal. It's very, very marginal. Here's the bounce we've seen in oil, but a big 2-day down move in here. That's the move they're talking about, 9% lower. We are seeing a bounce, but it looks like a bit dead cat bounce to me. And if I go into the intraday chart, you can see the market's capped off by that peak there. That peak there is 75.32, and we're fading back from there. I think this is a sell opportunity. This rebound, I think, offers sell opportunity. It was capped by that resistance there. I think all the threat for oil remains to the downside. Let's go to gold. Gold remains bullish. Okay, a strong session yesterday. We have dipped. I think this is a buy opportunity on gold. Going to the 15-minute chart. It's been a grind lower. I'd be now waiting for this. I'll be taking one of these lines in here. Sorry. I'm just going to redraw these. It's going to be easier than trying to move them around. But, you've got a couple of lines you could come off of the top here. So you've got the one that comes across here. That works really well. Comes through this point here, And you've got the more accelerated line. Okay. I'd be waiting for a break. I want confirmation through here, yeah? So, and confirmation through the more accelerated line also takes us up through that little peak there. So for me, gold, you get the buy trigger up through 1855.6. That's my buy trigger on gold because it will take me through the trend line and that little swing high. If it takes out the recent low, you can go short, but I wouldn't go through on this very recent low. I'd go through on the overnight low, 1849. And then that can offer up a move down towards like here, down to like 1842, and maybe deeper towards towards the mid 1830s. But my preference is going long there. Quick nod to the Treasury market. Take a look at the 10-year. So the bullishness remains. Higher prices, lower yields. Interestingly, given the Fed were that hawkish, right? We're still pushing higher prices, lower yields. We did get a slight dip back lower. And let me just add in I haven't got the. Bear me a second. I'm going to add a 15-minute chart in here as well. Just move that one across. Whoops. I don't know why it does that every time. Sorry, guys. Resize that. And then put this on the 15 minutes. Excuse the background noise as well, guys, in here. But here's a 15-minute chart. And you see, I think this is a kind of a flag pattern. We've got this holding period in here since the Fed. Okay, market kind of sideways. It's repeatedly held now. Support around 1303 down to 1302. So whilst above there, remaining bullish. And if you look at the little kind of counter trend line across the top, we're already up down, up through that. Okay, so for me, that very much that's the 10-year note remains bullish in here, whilst above 1303, 1302. Looking for it to take out the highs, and if we go back to the daily chart in here through the highs, you've got that high there. Yesterday's high was 1228 and a half, and then just above there you've got that's wrong, sorry. The high is 113.15 and a half, and then up through there again, it's that peak there when we looked at yesterday. Up through there can offer up to like 1328.29 kind of area, so remaining bullish there as well. All right, guys, that's what I've got for you today. Going to wish you all, as ever, a great trading day. Please stay safe, take care, and helmets and goggles on. Watching out for those data releases, watching out for the Fed speakers. And I'll be back with you with another bull versus bear webinar ahead of Friday's very much watched employment report. Take care, guys.